Well, our next guest is an economist at Harvard University and a former chief economist at the International Monetary Fund. He believes the status of the U.S. dollar as the world's currency of choice is fading and could disappear. He's the author of the new book, Our Dollar, Your Problem, an insider's view of 7 turbulent decades of global finance and the road ahead. Let's welcome Kenneth Rogoff to the program. He's Moritz C. Bose Professor of Economics at Harvard University and joins us now from Cambridge, Massachusetts. Kenneth, thank you a great deal for joining us. I've read a portion of your book, not all of it, but I've enjoyed that which I have read.
Thank you.
You are very critical of the Trump administration's trade and fiscal policies and what you believe will be the effects on the U.S. dollar. Let's wait a couple of minutes before we get there. And first of all, set us up with your view that U.S. dollar dominance, which has been a fact of the global economic order for decades and decades, peaked in 2015 when China became more flexible with its currency controls.
Yeah, just to be clear, I believe the U.S. dollar's fading, but it's going to stay there. It's not going to be replaced. But the role of the Chinese currency, the renminbi, the euro, and cryptocurrency are going to take up some of the dollar's market share, and the U.S. will end up paying higher interest rates, less effective sanctions, and stuff like that. So the dollar, was big after World War II. Europe, Canada, most of the time, you had a flexible exchange rate for a while, were circling around the dollar. Europe broke away. I mean, Europe's using the euro. Europe's not there anymore, and it has a significant share of the global economy around Europe. But what happened that made the dollar just so big was all these communist countries, China, Russia, started to enter the global economy, and they were centered around the dollar. And at the same time, the newly independent countries of Africa, Asia, and to some extent, countries post-military in Latin America, all started entering the global economy. And they're all using the dollar. And the dollar became bigger than any previous reserve global currency had ever been. It reached this incredible peak, ironically, after the financial crisis, which the U.S. probably caused. But it has been in decline with China breaking away, Europe collecting itself, but certainly, and I thought, I finished my book actually when I didn't know the outcome of the election because I saw the U.S. debt problem, which we're going to talk about later. That was both parties. That isn't the fault of one party or the other. It's the American people. And also the American belief that inflation would never be a problem. I saw these things as coming and accelerating the decline.
Okay, let's get to the Trump administration then. In a recent op-ed piece, I believe in the Wall Street Journal, you cited what you call the unsustainable debt trajectory, and you've just said that that is not a one-party or one administration issue. Ownership of the debt situation, in your view, belongs to both parties. It's Donald Trump who's in the White House now, of course, and the Republicans who control Congress. You also say challenges to the Fed's independence is an issue, and you say that is not only a Donald Trump story as well. Let's start with the fiscal situation and spiraling debt and deficits.
Well, the U.S. has come to believe, and many economists were saying this, they should be embarrassed, have been saying this for years and years, that debt just doesn't matter. You shouldn't pay any attention to it. You're the United States. Everyone loves you. You can just have as much debt as you want. And there's some truth to that, but it's exaggerated. Maybe the rest of the world holds a quarter of our debt, sometimes a third of our debt. It's okay, our debt can be, 25, 30% bigger. That doesn't mean it can go to the moon. And it is going to the moon. It was 30% of our GDP in 1980, 60% in 2005. 120+% today. And you'd think in that situation, both parties would be trying to bring the debt deficits, which is how much you're adding to the debt every year. You'd think they'd be trying to bring it under control, but Biden ran record deficits in peacetime. don't normally do that. I thought Trump would at least lower the deficits, but it looks like any realistic accounting of the big, beautiful bill that he calls it is going to have even higher deficits. And I suspect what we're going to see is the bond markets don't like it. They're going to be gradually pushing up US interest rates. And that's probably not going to stop for quite a while, and probably not until we have some kind of significant crisis that forces us to adjust.
One reason for that view that debt didn't matter was surely the ultra-low interest rates we saw for many, many years following the financial crisis. Correct? That era has now ended. Everybody's been reminded that interest rates and inflation can rise, and they have.
Absolutely. I was going around the world debating with leading economists like Paul Krugman, Larry Summers, Olivier Blanchard, and others that, yeah, the interest rates are low now, but when they rise, you're still stuck with the debt, and the interest rates on the debt are going to go up, and suddenly it's going to become painful. And they said, no, basically they're not going to rise, that they're going to stay low. Okay, maybe they won't stay high forever, but it looks that way right now. They've been high for a few years. The market thinks they'll be high for longer. I personally think they're a lot more likely to go up than down. So the moment has come where we really need to think about this, but our voters aren't ready. I think either political party that tried to push the idea until we actually have a crisis is just going to get voted out of office.
Okay, in your op-ed piece, you say this: although the greenback will almost certainly remain the world's dominant currency for at least a couple more decades, it will probably fall several notches. What do you mean by that? And is part of what you mean a sustained devaluation of the dollar versus other major currencies?
So, of course, we're not going to be using the euro much in New York, and we're certainly not going to be using the renminbi, and probably not either of those all that much in Canada. But what's put the dollar so high and made our interest rates so low and helped us borrow so much is that it's also used around the world. People would buy apartments in Moscow or India with dollars. Countries in Asia, but also in many emerging markets, were holding hundreds of billions, trillions of dollars. And that was keeping our interest rates down. And that let us not worry as much about debt. But that's one of the contributing factors. It's not the only one to what's going to push our interest rates up, and that's going to be more painful. Also, if there are other ways to do business, and the Chinese are working out their own financial system, Europe's working on a central bank digital currency and other things, our sanctions aren't going to work so well. Our sanctions work because there's the US, there's no other game in town. But that's not going to be true anymore. And there are other things we're going to lose where we become first among equals and not just the only game in town.
Kenneth Rogoff, thank you very much for this conversation. Kenneth Rogoff is a professor of economics at Harvard University.